Welcome to Trading the Markets. This is Mitchell Joseph. I'm not a financial advisor, so everything here is just for educational purposes. So I want to go over entry because entry is everything. Like when it comes to your ability to make money, the better price you get in, the more room you get to make the money. So I'm gonna go over a trade that I took. Let me share my whole screen. I'm gonna go over a trade that I took on Thursday last week. All right, so this is my journal. So I also have a trading journal. It's very important to document everything that you're doing, especially if you want to get better. You need to know what does it look like when it's time to get in. So this was a trade that I went in. Well, just real quick, you see that I entered at 0.22, which is $22 per contract. I got out at 34. I had about 5 contracts, so put in 110, made about $60 in a matter of 20 minutes. But so this is day trading, this is scalping. But now you see this. Now let me show you what went behind for me to even take this trade. So I'm gonna go to the actual trade now, the actual chart on TradingView. And so this was UVXY, right? And then I think I was on the 5 minute. Um, hold on, I know. All right, here it was. This was just. I'm gonna go back in time. By the way, this is what's really cool about TradingView is that you can do replay, where you can go back in time. So okay, this is the beginning of the day, Thursday. All right, so I'm gonna. This is the 5 minute. All right, let me replay. Boom. All right. So this was before the day even started, right? And hold on 1 second. Let me just send this text. Uh, All right. So this is what I. So this was the previous day. So now the market, the day just started. Boom. That's the first candle on Thursday. And just to make it even clearer, I'll take away the clouds. Right. That's the first candle on Thursday. Now, the first thing I noticed.
The orange one is the first candle?
Yep. So orange is red and blue
Right,
is
right.
green. Yeah,
Yep.
I pick these colors because it's dull. It makes me not emotional, you know. I see
That's
red a
funny.
lot. I see red, so it just keeps me calm and relaxed, and that's how you want to stay. So
Okay.
yeah, because you got to understand, like, the market is an auction. It's literally like a farmer's market. So they're trying to get you in, like, oh, look, the price looks good. Get in right now, get in right now. So they're gonna bring the price up and down to market it to different participants to get in, and that's all it is. So the first thing I noticed is that we open inside the range of the previous day. So notice that. Let me move these lines, right? So, not this one. Move the red line if I can. I'm gonna have to move the yellow too. All right. So notice that between the red and the blue, this is the high and the low of the previous day. You see, this says Wednesday right here.
Yep.
So this is Wednesday. The beginning of Wednesday is at 8 o'clock, which was just so you know, right here, right here. So I'll even like separate it just so you can keep track, right? So this is Wednesday. This is the beginning of the day, Wednesday, clone, and then this is the beginning of the day, Thursday. So you see, these are 5 minute candles. So this shows what happened every 5 minute increment. Do you know how to read these?
What's mine?
What's going on? What's going on, V? All right, but Tracy, do you know how to read these candles?
That's what I'm learning now. So I know some of it, I just don't know all of it.
Okay, so all you need to know,
Well, meaning like the open and close and
yeah,
stuff
open
like
and
that.
close
Oh
and high
yeah,
and
yeah.
low.
Yep,
Okay.
yep, I know that.
All right, bet. So, all right, so this is the first candle. So now, all right, so what I do when you day trade, I like to let the market develop a little bit because if I just go off this, I'm going off of nothing. I need to see how people are moving, how buyers and sellers are moving before I make a choice. So let it play out. Let it play out usually the first half an hour. So first 5, 6 candles. So that's 1, 2, 3, 4, 5. Let's do one more, right? All right, so boom. So first 5 is 6 candles. So what I noticed right here is that there's a gap. You see the gap between where we closed at yesterday versus where we opened at today. So that's the gap. So my first inclination is, are we gonna fill that gap? You know what I mean? That's my first thought. So that would make it go up. But here's the thing. This has already gone up so much that if I want to go, if I want to play the upside, right? If I want to do something like this, where I play the upside, where this is where I get in, the red is my stop loss, where I would get out if I'm wrong, and then where I will profit. It's that this might keep going further and further, and I don't have a very steady, confident place to put my stop loss. Does that make sense?
Yeah, that does make sense.
Yeah, so you always want to make sure that the risk to reward, the risk is smaller than the reward. That is always more meat on the bone than what you're risking. So when things run up so high, you don't want to buy at the top, right? Unless it does something, right? And then you don't want to buy it, and you don't want to sell at the bottom for it to go lower unless it does something else. So I'm gonna show you about what that something else is, right? So I see this, right? So now I'm just gonna let it play out because what I'm looking for now is I seen this resistance. You see this rejection right here? That's what you call a double top. That's resistance. Price has not been able to get over this level. So what am I thinking? That if it comes back, it's gonna struggle again. Why? Because this is on a downtrend. Like if you look at this, it's been going down. Yeah, it popped, but overall, this is going down. Do you guys see that?
Okay, yeah, I do see
So
that.
it's a clear downtrend, but it's going up in the middle of that downtrend. So what you want to do, so understand, if it was an uptrend, you buy the dip because overall, over time, it's going to go up. But if it's going down, you want to sell the rip. So when it shoots up, you want to look for a good place to sell so it can go back down because that's where it wants to go. Does that make sense?
Yeah, that makes total sense.
Yep. So it's all about understanding the trend direction on the. See, I'm looking at the daily time frame. The daily is going to give you the direction, But then from the daily, I have to look back and see what has been the main direction. And the reason why I trade this because it always goes down. Like it always has to go down. So a few times when it goes up, I just know how to account for that, and I know how to wait for it. But I love to play this to the downside as much as possible. So right there and then my direction is set. I'm looking for cells. That makes sense? You see how I found direction?
Yep, yep.
All right. Let me know if you got any questions, V. Walsey.
Yeah, yo,
Yeah,
did you put
so
puts in for this or no? For the
yeah,
VIX?
puts.
All right, cool.
But notice that I'm buying puts in the middle of a counter trend as it's shooting up.
Right.
So I have to be careful because imagine you buy puts right here, you get destroyed. Imagine you got puts right here, you get destroyed. So it's like even though this is mostly going to go down, you can still get caught up on the few times that it goes up like crazy. Like right here, right here. So you see it has this, it's very sporadic. And this is the VIX, by the way. So this is volatility. Volatility is how much something goes up and down. So by trading the VIX, I'm trading the actual up and downness of the market itself. Crazy, right? So, and I love to trade this because I make money two ways. Because if the market shoots up, this goes down. But if the market just stays and doesn't move much, guess what? Volatility goes down. So I make money to the downside that way, two ways. So now, right? So now you understand direction. So you want to look at, so whenever you do the charts, you look at the daily, then you want to size down 4 hour, 1 hour, and then you start to, okay, I see where I am on the big picture, but inside that little segment, where am I at so I can get in? You know what I mean? It's like you're trying to catch a ride to like from Boston to like Cali, but you got to figure out, okay, this is going to Cali, but when? Because you hop on the bus right now, it's going to go to Maine. You see what I'm saying? So you have to catch the right timing of when to catch that bus to the direction that you're trying to go. Does that make sense? So now,
Yep, that makes sense.
all right. So now we know that we're trying to go down, but all right, for us to go down, you see this box I made? I'm like, I'm not buying puts until we get inside this box. Not only that, I want us to go in this box come get reject, because you know, just like this, you see how it rejects, right? We need the rejection as the confirmation, but then I want it to come back up again and then reject the second time and then go in. That was my plan, right? If it goes down, my plan, if it goes up, was this, because it could still go up. So the plan was a drawing. So now when something goes up, this is what you want to see. You want to see it break the resistance that it couldn't break over, right? Come back, retest it, and then keep going up higher. Does that make sense? This is the structure you want to see for something that's going to keep going up. It got to clear the level it couldn't get over. So now the ceiling becomes the floor that it bounces off of to push higher, when before the floor was pushing it down from getting higher. Does that make sense?
Yeah, I was gonna ask why, but you just explained that. So, okay, got it.
Yeah, you want the ceiling to become the floor. But I want the ceiling to remain the ceiling. So that's why I'm doing what I'm doing. So now let it play out, right? Came down. I'm like, damn, I wanted to go down. Why don't I get in now? I'm like, no, I have a plan. Why am I gonna get in now? Because if I get in now, I'm paying a markup. I want to pay a discount. I'm not paying. You have to be bougie with your money in the market. You gotta tell them, no, I'm not. You guys want to make it look good for me to get in right now? Oh, I'm gonna miss out. Nope. I'm gonna miss out then. Miss out then. I have my plan. Either you're gonna go to my plan or I'm not chasing you. You're gonna chase me. You know, I look at these stocks like they're women sometimes. But but look, so you see that? So okay, first thing happened. What did I want? I wanted to come up into this top of the yellow and reject. What did it do? It rejected, right? So then what did I say I want after rejection? I wanted to come back up and reject again, right? So, but honestly, I could have gotten in right here. I think I did get in, like, so I got in right there. Okay. So look,
What
you
is
see
it, a
that?
daily or a weekly?
This is 5 minute. You see the 5 right here?
5 minutes?
So
I
5 minutes,
see.
right? This is the beginning of the day right here. Thursday. You see? So now you can see this right here. It's called a double top. You see how the top right here? So try to go up, rejected. Try to go up again a second time, rejected again. That's already showing you weakness that it can't go any higher, right? Then when it came back up again. Look at how this level right here, this was also a floor that became a ceiling. You guys see that?
Yep.
So you got to train your eyes to see this in real time, you know? So now that I've seen this, guess what? I'm in the trade, Volsy. It did my plan. Just because it didn't come out this far, all I wanted to see is go up in here, reject, come back up, reject, and then shoot down. Went up in there, came back, reject, now it's shooting down. What am I waiting for? And you know what the best part is? My stop loss is just gonna be right above this. You know what I mean? And then my target could be these lows right here. So I look to the left for my targets and my stops. I look to the left. I see it hasn't been able to get any higher than this. So I put my stop loss above this and be confident, right? Now, where has it gone? It's gone this low. This is another low. There's another low. So I can try to take one of these as targets, maybe sell some and then keep running and then until it stops, just sell them all, right? So now in the now we in the trade. You see that? Now I'm in the trade. This area represents me entering the trade at this time at 10:45, right? Now that I'm in the trade, look how quickly the trade worked out. So right here, I got out. Like right here, I'm like, all right, that's good enough. You know what I mean? Even though I targeted these lows right here, it was close enough that I couldn't complain because at the end of the day, oh yeah, it stopped sharing. Hold on. So let me share the other screen. At the end of the day, as you guys can see, they were $22 and they went to 34. And from down here, you know, I show this is the previous area of resistance. There's a double top. And like I said, it opened inside the previous day range. So once it came right there, I was out of the trade. I didn't wait for it to come back up, play around, and then go lower. You guys see that? So when you're day trading, you're trying to get in and get out. Clear target, clear get in, clear get out. If it's not going up, if it's not going to my plan, why am I still in? And you can see, and here's some extra credit right here, right? So this is a chart of the option that I played, which is the $8 puts, right? So notice where I got in was right here. So notice this is the beginning of the day. And then I noticed that it made a little gap right here, right? So like from 9:30, 10 o'clock, it kept going down. And you see around 10 o'clock, it started getting tighter. But you see this parallel channel right here? When you get a parallel channel going in the direction, that's a reversal structure. So I knew that had a high likelihood of reversing. You guys see that? So off that reversal structure, I entered as soon as it broke out of there. You see my entry was 22, and then I sold it at 35.
Got it. I got that.
And mind you,
Clear.
this is per contract. This is the actual option contract. So this is not the chart. This is the contract. So this is the chart. This is the chart of the stock. This is the chart of the option contract that I paid for, which was the $8 puts expiring February 2nd. So those contracts, you see that they opened up the day at around 35. They made a high at 40, came down to 25, then it went back up to like 35. Then you see it made a low down here at like 18. You see that? So what I'm doing all day, I'm watching it like a hawk, and I'm like, I want to get in, but I know that once we get up there, the price is gonna drop. You know what I mean? From the morning, and then once we get up to that yellow area, once we go from down here to the yellow, I know that the price is gonna drop, and I know that that's where I need to pounce somewhere in here. So me looking at this at the same time I'm looking at this gave me more confidence that once it broke out of the structure, that it had a high chance of going back up to where it opened up at in the morning. You know what I mean? So, and then there was a little gap. So I figured that this would be a good place to take profit based off this gap being filled on the premium chart. Any questions? Yeah, y'all straight?
Yeah, we good. We good.
All right, yeah. So then, because the benefit of this, like I'm telling you, like my biggest edge that people don't do is look at the premium chart. Pick the option that you want to buy and stock it like a hawk. Look at what are the past price the past price levels that it's been at. You know what is the low? What is the high? Because then you can determine, am I buying this at a discount or am I getting beat on the head? Because if I bought this, like, look, if I had bought this up here at like 8:30, 8:40, I would have paid $40 for this. You see what I'm saying? This same option, an hour later, hour and a half later, is going for 18. You know what I mean? So now that I see that, I know I could buy it for 18 and potentially sell it for 40. But I'm not greedy. As soon as I seen a out, I got out at 35. And guess what? It went to 39. So if I put 40, I would have been missed it by $1. You see that? So I use what's available to me to make better decisions. And this is definitely more advanced, but it works like crazy. So all right, so that was that trade right there, all right? So you guys have any questions? Any questions, anything you want me to look at, Volsy?
No, everything was like on a down trend today.
Yeah, the market did go down today.
What's it called? The PLRT?
Well, it actually went up at the end of the day. Oh, PLTR, you said?
PLTR, yeah, that's what it was.
Oh, you're in it? I'm in it. You see where it is right now?
Yeah, I got in on that call. I mean, call too.
Bro, let me show you where it is right now. Let me show you where it is right now. Let me go on the 1 hour, right? And then I'm gonna
So I
put up.
think I got a little bit lower than I think what you get for 36 or
No, I got it for
was like
42.
42. I think I got a little bit under
Yeah,
that.
I'll show you. Matter of fact, let me go to Robinhood so I could just show you there. Let me open it on a different tab. Well, I'll show you. So first, I'll show you here because I'm already here. So let me show you after hours here. You see that?
Oh wow.
Yeah. So
It's-
imagine where we're gonna open up
Take a
at
look at it.
tomorrow. Imagine where we're gonna open up at tomorrow, bro.
What did you put a limit order? I mean a sell price on that?
Nah, I didn't. Because this is earnings. This can go to the moon or who knows where it can go.
Because
But
you said all-time lows, right? Is that what you said?
the low of the day. Yeah, so let me show you.
The low for the day.
Low of the day. Let me show you Robinhood. So Robinhood has this too. The same thing I'm showing you with the price of the options, Robinhood has it too. So look, PLTR, these are the contracts that I have, right? So look, I got 2 contracts for 41. You see this, Tracy? $41. So basically $82 in there, right? And then you see I bought it today, and you see the price right now. So look, PLTR, it's at 1955, but it closed the day at 17. What? It closed the day at. Hold on, let me take this off. It closed the day at 1673. So it's already up $3 in the after hours. $3. What does that mean, right? What does that equate to? I'm glad you asked. This is why Robinhood is dope, because they have this feature right here where you can simulate your returns. Where is it?
Yes.
Hold on. Oh yeah, let me go to the option. Let me go back. Yeah, so now I'm on the option, right? So look, simulate my returns. You guys see this button right here? So I implore you, yo, bro, this is why Robinhood got actually stepped their game up. I click on this right here. Now look, you see
But I realized I had that feature.
you see where the price is right now? 1956. You see
Yeah.
how much my profits is gonna be right now?
Yeah,
You
1956.
see
Yep,
how
Yeah.
much
yep.
do you see how much the contract got price is gonna be?
The
You guys see
price
that?
what's the price?
143 right here. 143. Remember, I paid how much? 43 per contract. So
Wait,
tomorrow, so if the price opens up at 1960 tomorrow morning, I'll make $200 from my $80 investment.
that's crazy.
That's crazy, right? And that's the power of earnings. That's the part. The thing about options is that as they keep making more money, it's like a multiplier. You know what I mean? So you keep making more and more money as it keeps going your way. So now we can play around with this. Okay, let's say we open up at 20 tomorrow. 244. You see that? 2050. 298. 21. It could happen. 362.
This
You know what I
contract is
mean?
this contract's up next week, right?
They expire next week. Yeah.
Oh, so you still got time.
And I have one for this week too. Let me show you. PLTR. Right here. I bought one, right? I bought some of them on Thinkorswim too. But look, so this is out the money. $22 call expiring on Friday, right? So I bought for this week, right? Simulate my returns. Let's see, where would I be at? See, I'm already up $55. How much did I spend? 15.
Wow.
Yeah. So I mean, my only regret is I didn't have more money in my account today, because I would have bought a lot more. But it's okay.
Yeah.
hmm
I
Yeah.
gotta check that out tomorrow.
But it's only because of earnings. You gotta understand. So like if this opens up at 2068, if this opens up at 21 tomorrow, my $15 will turn to 108 plus 15. You know what I mean? 122. So that's what's so beautiful about it. But now the reason why, look, is this right here. You see this? You guys see this? They beat earnings. They beat on earnings and they beat on revenue. So every 3 months, companies report on how much money they're making per share. You know what I mean? So that's called earnings, letting you know as investors that have stocks, how much money are they making as a company? You know what I mean? So based off that number, it will encourage, investors to stay with you or leave or whatnot. So that causes crazy price fluctuations, right? It causes crazy price fluctuations because the thing that makes options different is because of this right here. You guys see the Greeks. So this is what you gotta learn, Tracy. The Greeks when it comes to options. So delta is how much money you'll make if the stock moves up or down $1. So if tomorrow you see it's so it was actually at 1668. So if it opened at 1768 tomorrow, then I would have made $10. You know what I mean? And then theta is how much money you lose every day from just holding on to it if it doesn't move. Does that make sense?
Yeah, I didn't know this.
Yeah, this is what makes options completely special from stocks because there's a time element. So they have to make it sensitive based off the time and based off how close you are or far away you are from the price. You know what I mean? So
Yeah, no, I didn't know that they showed like this whole part right here, the Greeks. I didn't know that.
oh yeah. So but you have to no, you don't even have to buy. I don't think you have to buy option. It'll show it. I think even when you're looking at it, it'll show. Let me see. View all options. Yeah, even when you look at it, you just slide down and it'll show it right there. It'll show it.
Okay.
Yeah. But you have to enable options trading. So if you don't have options trading enabled, you won't even be able to do any of this.
Got it.
So if you want to know how to do that, just YouTube it. It'll be really quick. It's just you gotta know where to go on your Robinhood app to do that. Let's see.
Okay.
If you need more help, you can let me know. I'll help you. But what was I gonna say? Oh yeah, the Greeks. Yeah. So the Greeks. Yeah. So okay. So that's delta, right? And then that's theta, right? But then here is what makes options different. Is when you come right here, you see where it says implied volatility. That's stocks don't have implied volatility. They have historical volatility based off history, based off of the past. But this is looking forward to a certain date. So based off that date, people will imply how much is going to move. People are going to guess how big it was going to move. Like, oh, earnings, yo, it's about to move $5. You know what I mean? People just have a certain guess, the market, and then the market prices that in and says that this is the expected move. So implied volatility shows you the expected move, but understand that the reason why this is so high is because of its earnings. If I go to other dates, other expiration dates, it's not going to be this high, But because of this number right here, it affects Vega. So Vega is also, so this is the gas, right? This is what you call the hype. This is why options is nothing but hype and gas, because this is how sensitive it is to gas, which is implied volatility. So for every 1% of implied volatility, this is going to move you. And in all these numbers, you have to times it by 100. So it's going to move 30 cents for every percent of implied volatility. So if this goes up another 100% of implied volatility, it's going to move 30 cents times 100. So it's going to move $3 per contract. Does that make sense?
Yep, that makes sense.
Yeah. So this is telling you how sensitive it is to implied volatility. So because of implied volatility, so what you'll notice, right? What options is that you don't get paid based off of how much it moves exactly. You know what I mean? It's more about how much expectations there is behind the move. So what I mean is that like as time goes on, the expectations goes down. So let's just say like you buy something at $1 and people expect it to go to $2 by the end of the week, right? Well, let's just say the first day you move 50 cents. That you're gonna make mad money because you blew through the expectations. You know what I mean? So let's just say, it moved 50 cents, but then let's say the next day it drops back 30 cents or 20 cents. You might find yourself worse than what you started at, even though you're further ahead than where you started at. Does that make sense?
Yep, that does make sense.
So basically the price does not have to move for the price of your options to move. Sometimes, especially after these events, let's say I was wrong and these failed. So let's just say they failed. So I would lose money in the morning, right? And then let's say in the morning they started to go back up. I still would lose money. Does that make sense?
Yep.
Because it didn't meet the expectation. Yeah, it did not meet expectations. So whenever you that's really aggravating because the people will be upset, be like, wait a minute, like my option is going up, like I'm right about direction, but I'm still losing money because implied volatility went down. Because the implied volatility was 196% today, and then tomorrow it's at 56. So you just lost all that. And so that's why when it comes to playing these, you have to understand that every single option is not created equal, and every single one is a tool, but you got to pick the right tool for the expected move that you see. You know what I mean? So aside from that, gamma is how much delta goes up every dollar move. So this is what I said, the multiplier. Gamma is the multiplier. So the first dollar, it goes up $10 a contract, right? The second dollar, it goes up $10 a contract plus 530. So it goes up 1550 on the second dollar move. You get that? So
Yep.
the first dollar move, it goes up 1020. Second dollar move, it goes 1020 plus 553. So it goes up 1550 on that second dollar move. So from a $2 move, it went up $25 per contract. Then you throw in the third dollar move, so you throw another 550 on top of that. So then the third dollar move is going to be a $20 move by itself on top of the previous 25. Does that make sense? So you see how this thing can add up really quickly, right?
So is this something that you look at on a daily?
Yeah. Whenever I'm picking an option, I look at these Greeks.
Right.
Yeah.
Okay,
Every
okay.
time
Yeah,
I'm
I
picking.
see why it's important too.
Because for one thing, I don't want to buy an option where, especially it depends, right? But let's say it has decent time on it. I wouldn't want to buy an option where the theta is 50, but the delta is 10. You see what I'm saying?
Right.
So just from holding this, I already lose what takes $5 to make it up. You know what I mean? So you got to make sure your delta to theta ratio is good. And I pick, like, what I do is I want my delta to theta ratio depends, but I like 2 to 3 times. But it does depend, on like how short term or how long term, how much time is on the options. But if I have adequate time, then I want to at least double the delta to theta. But it also depends on how high the implied volatility is. So when you're starting off, don't trade things like this. Trade things that have like 50% or lower, because it's not going to move that much crazy. Especially if you're holding it overnight. You don't want it to move too crazy overnight on you. And then you guys know bid and ask. So the bid, that's how much buyers want to buy it for. Ask, that's how much sellers want to sell it for. And then open interest, that's how many contracts are open. So there's 4,463 of these contracts that are open right now. And I got one of them. And then volume, that's how many contracts were traded today. So today, 10,790 of these were traded today. And then it tells you the low. The low of the day was $11. The high of the day was 21. So when you're buying, try to buy close to the low. Previous close yesterday, it closed at $9. Last trade was 14. And that's probably me. Well, actually, I paid 14, I think. Yeah, I paid 14, but it's at 15. All right, so any questions, y'all?
No.
All right, so pay attention to that Volcy in the morning. Like, let's see how high this thing opens up. You still there? I don't know if you're still there, but let's see how high this thing opens up in the morning. Because the fact that it's 19 now, I think like tomorrow, like this can go up to 21, 22. And mind you, from 16 to 22, even like, and that's the benefit of options. Like if I had shares 16 to 22, that would be a nice gain. That would be like a nice 50% gain, or something like that. But I can make hundreds of percents in options from the same move. And that's why I love options, because it's leverage once you know what you're doing with it though. All right. Thank you for tapping in, Tracy. Thank you for tapping in, Valsi.
Thank you. Thank you so much. I appreciate this.
No problem. Definitely let me know if you have any questions later.
I will. Thank you. Good night.
All right, bye. Good night.